Ladies and gentlemen, thank you for taking the time today to join us for the latest Abbey Wealth investment webinar. I'm delighted to welcome back Will Mcintosh-Whyte from Rathbones in London. Rathbones trace their history back to 1742 and have over £60 billion of assets under management. Will always has some interesting insights into what is happening in the world today. I hope you find this webinar informative. The format today will be a presentation from Will, followed by a Q&A session. Please use the chat function to send through any questions that you may have, and thank you for those that sent through their questions in advance. Please keep your microphone on mute so we don't get any background noise. So Will, thank you for joining us. It's great to have you back again. Not wishing to bowl you a googly at the beginning of the presentation, hopefully you'll cover this in today's call, but the question on a lot of our clients' lips at the moment, a question we get asked, with interest rates where they are at the moment, why would I invest and not just sit on cash? So Will, look, great to have you back. Over to you.
Thanks, Ian. And nothing like a nice tricky question right out the gate. To be honest, as you might imagine, it's a question we get asked quite a lot. And you're absolutely right. I will cover it off, and I may as well cover it off now, I think. I mean, my first slide, okay, it does work, excellent. Kind of starts with that point. I mean, you can see here, this is US rates, and you can see US rates are now, 35.5. UK rates have gone up, European rates have gone up. And you're right that if you have your money in a bank, you can get a more attractive rate than you did. Admittedly, you probably pay tax on the income that you get from that. If you tie up your money with a bank, you can get a slightly more attractive rate on a sort of 1-year basis and lock that in. And again, you've got to consider the fact that you are paying tax on that in the main, not for everybody, but many people will be paying a reasonable chunk of that away to the tax man. But yet, that headline rate does look attractive. And so, as you say, why would you not just, park your money there? And I think there's a few elements to cover on this. One, it does come back to time horizon, as ever. If you have a very short time horizon, if you have plans for your money in 1 year's time, buying a property, whatever that may be, and absolutely right, I'd be parking my cash in the bank account. But if you are investing for the longer term, with a longer term time horizon, trying to grow your funds either above cash or, if you're willing to take a little bit more risk, ideally trying to beat inflation. And obviously, that's been a tricky task over the last couple of years with the inflation spike that we've had. But nonetheless remains exactly what we are trying to do over longer term. And trying to come in and out of markets is a very dangerous game, really. It does feel that, markets have had an okay run and, maybe I should just be hiding in 5%. But, if you time markets, and typically people don't tend to get it right, they tend to come out at the wrong time and then maybe miss out if the market rallies and get back in. And if you miss some of those big market days where you have big market moves, it can really impact your longer term return. So that's, for one very important thing to consider. Within the funds, there's a couple of points as well. Is one, we can be quite nimble. So we can hold cash as well ourselves within the funds. We actually get base rate minus 25 basis points. So in the UK, we are getting 5% on our cash that we hold because base rates are north of 5, which is not an unattractive return. And it means that if we want to have a little bit of dry powder, it's not sitting there doing nothing. We're also able to put money to work in what is a much more attractive environment from a bond perspective right now. So as you can see, because rates have moved so aggressively higher, you can lock in some of these rates by buying bonds slightly further out. So you can buy, we're buying quite a lot of 3, 4, 5 year corporate bonds and they are locking in rates of 7%, 8% in some cases for those 5 years. So locking in a much more attractive rate than just cash and what you're getting in a bank, and you're locking it in for a number of years. And I think it's important to remember that right now, a lot of people are talking about rates staying higher for longer. What that period might be, we will see. I mean, inflation certainly looks like it's coming down fairly aggressively. And I guess the danger is you think, oh, well, maybe you lock in a 1-year bond and you get your 5%. But in 1 year's time, what are you going to be able to do with that cash? And there is the risk that actually inflation has come down. Inflation's back at 2-3%, and that actually interest rates have come down, and the banks are no longer offering those attractive rates. And so you've picked up your 5%, but then you're reinvesting at maybe 2%. And in the meantime, equity markets might have rallied, because equities, will potentially do well in a lower inflation environment if interest rates are being cut. Those bonds that we bought, locking in those 7-8% returns, will have given us some capital gains as well. So not only getting in a higher level of income, but if interest rates come down, those bonds will go up in value. And so again, by going into cash, you do risk leaving a little bit on the table. And ultimately, if inflation is a little bit stickier, the real returns that you are getting on that cash, are not massively attractive. If you've got inflation at 3%, say, and I know in certain places a bit higher than that right now, but you're getting a 2% real return, which is okay. It's okay, but we are also able to put that money to work in a lot of range of attractive equities that have very good long-term horizons. And we think, and they're also able to manage an inflationary environment relatively well. A lot of the companies we focus on have very strong pricing power, have very good cost controls. And so each year, if inflation does stick around, they're able to push their prices higher and capture that and protect their top line, and ultimately grow their earnings ideally ahead of inflation. And so, we think that, as you say, if you have that long-term horizon, you're much better off staying invested for the longer term, not trying to time the market, giving us the ability to lock in rates where we think it's appropriate, whether that's some of those corporate bonds, some government bonds, which we've also been buying. We've been buying some of the 10-year more recently, locking in, 4.5 to 5% returns for the next 10 years. So we are locking in those rates for a much longer period than just going for 1 year. And so, as I say, there's a number of reasons there. And I think, as I say, also that, rather than trying to time the market coming in and out, stay invested and allow us to do that and raise cash when we think it's appropriate, get paid that 5% while we're holding that dry powder, and then put that money to work, if we see a bit of market volatility, give us some opportunities.
Would you say at the moment then that your strategy versus, I don't know, 2-3 years ago, you are sitting on a high percentage of cash, a high percentage of bonds, or is it a case you're just holding different type of bonds than you were 3-4 years ago?
I mean, 3 or 4 years ago, when rates were zero, basically. I mean, if you think about what you're able to get from a 10-year government bond in 2020, in the UK at one point, it was about 0.2%. So people were buying these government bonds and accepting a 0.2% return a year for the next 10 years. We were not buying those assets. They were way too expensive for us. They weren't doing the job in the portfolio that we want of bonds, which is providing an element of protection. Actually, we were concerned that they were providing an element of risk. And what you've seen is rates have risen. Those bond yields have risen, and when bond yields rise, that means the price is going down. And so by holding those government bonds, if you've held them for 2 or 3 years, you are sitting on big losses. And as I say, and you can see it in the returns of our lower risk funds, which actually held up relatively well the last couple of years, versus some peers who were in a lot of bonds, a lot of longer dated bonds, and it was quite painful. For us, we had a lot of cash. at the time, which we weren't getting paid on back then, actually. But our view was we were better off in cash getting paid next to nothing than putting that cash in government bonds and taking a lot of risk. And as I say, that has played out in helping protect the portfolios over the last couple of years. We've spent the last 18 months pivoting from holding lots of cash and lots of very short dated bonds to buying much more longer dated bonds. So we've got a lot more bonds than we had before. We've got longer dated bonds than we had before. We've got more diversifiers than we had before as well. So we have aggressively really pivoted the portfolio to reflect this higher rate environment. And that's because we are seeing opportunities that we've not seen for some time. In bonds. So you can now buy, as I said, 10-year government bonds, giving you a 4.5% to 5% yield. That is what you're going to get each year. If you go into a difficult economic environment, these things are likely to go up in value and help protect the portfolio. So you can buy that hedge and yet you can get paid for it a decent clip. So we think that is quite attractive in the current market environment right now, and it's a position we haven't been in for some time. We've been buying infrastructure funds, which, as you well know, are not something that we've ever bought before. And these infrastructure funds, there's a sort of mix of them. You can either buy real assets, backed by physical assets, or you can buy the debt side. And I'm not going to get too much into the technicals, but these are investment trusts. And once upon a time, they were trading on big premiums. So people are actually paying more than what they were worth. Don't ask me why. Sometimes the markets are a bit odd. And those things have seen a significant amount of pain, and they are now trading at big discounts to their net asset value. And for us, we think that is attractive now. You're getting paid to take that risk. And so we are buying assets that are giving you a 6% yield, and they're a 25% discount to their net asset value. Well, some of them are giving us a 10% dividend yield, and again, also on a big discount to their net asset value. So these are the type of opportunities that we're able to access in this slightly difficult environment, because rates are where they are. Now, let's be clear, the problem with rates where they are, it's a bit of a squeeze on the economy. And there's no doubt about that. You can see here, the grey line shows where we've gone, or where we've come from, and where we are now. And that is a big, steep rise in a relatively short period of time. Now, having said that, things are a little bit different to how they've been historically. And we're always wary of comparing, current periods with previous periods, because things change significantly over time. And you only need to think about the UK mortgage market, whereby a vast majority of people in 10 years ago were on floating rate mortgages. Today, that figure is less than 10%. So as rates have gone up in the UK, very few people have been immediately impacted. Now, over time, more people are coming off their 2-year fixed rate or their 5-year fixed rate, and they're having a fix at a significantly higher level than where they were before. So that creates a bit of a squeeze on the consumer. But it's a very different environment from where we were 10 years ago, when as those rates went up, your mortgage payments went up month after month after month immediately, and you had that immediate pass through. And if you're in the US, you can essentially remortgage as regularly as you like. And so as rates came down in the US, households were remortgaging aggressively again and again and again. And many of them, and you can fix your mortgage in the US for 30 years. So now many people have remortgaged at, 1.5%, 2% for the next 30 years. So even though mortgage rates in the US have gone through the roof, actually, it hasn't really affected most households because their mortgages are fixed for the long term. Now, it's affected the new buyers, unfortunately. Unfortunately for the young, their lives continue. It seems to be that they continue to get more difficult, But for the vast majority, if you don't already own your home, and that's another point to make, is that the world has moved on. Many more people now own their home outright than they did before. But if you don't already own your home outright, your mortgage hasn't moved. So again, even though rates have gone up significantly, the immediate impact on households is a lot less than it used to be. Now, it's not nothing, your credit card debt goes up. Any personal loans you've got probably go up as well. Or if you've financed your car, that rolls off, that will have an impact. So there's not no impact. Let's be very clear about that. But I think the impact is slower and it takes more time to feed through. And it's a similar point with companies, actually. Many companies have financed themselves when rates were very low for a very long time. They issued long bonds with a 1-2% coupon. And that's all they have to pay on their debt for the next 10, 20 years. So again, they don't have that issue of having to pay more and more back to the bank because rates have gone up. However, we don't want to be complacent about that. We think about the consumer, and the consumer's in an okay space, as I say, for all the reasons I just explained. And actually, through COVID, lots of people have built up nice levels of savings. Wages are going up quite significantly. In the US, inflation has come right down, and I'll show you a chart in a minute, but inflation has come right down in the US, and yet they're still getting wage growth of around 4.5%. So actually, in real terms, people are seeing real wage increases in the US, which is, quite a positive. In the UK, people still seem to be getting 7 or 8% wage increases. I'm not quite sure who these people are, I have to say, Ian, because it's not happening here. And when I talk to various circles, they don't seem to be seeing that.
Do you want to speak to my boss on that, please?
Well, exactly. But, for those that are seeing those wage increases of that level, it's compensating for inflation. And actually, as you say, if your mortgage isn't going up either, then actually maybe you're seeing more income coming into your bank account than was going out before. So actually you're getting more money in than you were before. And the other point to make is there are plenty of people here on this call, I'm sure, who will be invested with us. They'll have some cash in the bank and they're getting paid more interest on that cash on the bank. So actually, they are getting a little bit of income from their cash holdings as well. So lots of reasons why the consumer is not in too bad a position from a sort of global perspective. And when I really talk about this, we focus quite a lot on the US. We're a global portfolio. The US is so important to the global economy and to our portfolios. And for us, looking across the pond, the US consumer continues to look in pretty good shape. As I say, you don't want to be complacent.
Will, can I, sorry to go back to the previous slide before we move on. Can you just explain that slide in a little bit more detail, what each line represents? And then I've got a couple of questions that have come through that are more relevant to this section before we move on.
Okay, this is showing you on the bottom. These are months since hiking began. So when the Federal Reserve, the US central bank, start hiking rates, this is showing you how long it takes and how high the interest rates have gone. So in 2015 to 2018, they started hiking rates, and 35 months later, they were only at 2%. Whereas now, from when they started hiking rates, we are 20 months later and we're at 5.5%. So the pace has been much quicker and the magnitude has been much higher. And this is just showing you historically in sort of modern history, if you like, from the period when the Fed started hiking rates, this is the quickest and highest that they have moved.
Thank you. A question that came through, do you feel there's a sufficiently confirmed trend in inflation to switch out of inflation-protected fixed income instruments, such as TIPS, and into more exposed bonds, i.e. emerging market corporate ones?
So for us, our view is that inflation has come down materially in the US. So when you're talking TIPS, that is US inflation-protected securities. So The idea with these bonds is that their coupons rise in line with inflation. Now, you've got to be careful with these a little bit because their valuation fluctuates and depends on what the market thinks inflation is going to be for the next 10 years. So at the moment, US tips, so those inflation-linked bonds, are pricing in that inflation is going to be about 2.2% on average for the next 10 years. So some might say, doesn't that look attractive? And it looks okay. It looks okay. And you can get a little bit of a hedge from buying those bonds. If inflation is higher than 2.2% over the next 10 years, you'll be better off being in those inflation protected bonds than you will be being in conventional bonds. For us, from a portfolio perspective, we'd rather be in conventional bonds, mainly because if we see markets get a little tricky, conventional bonds tend to perform better than those inflation-linked bonds. If inflation is a little bit higher and economies tend to do well, okay, our conventional bonds won't do quite as well, but I'd expect our equities to do pretty well in that kind of market environment. So it's a little bit of a balance there, and it kind of depends what angle you're coming at. But for us, from a portfolio construction perspective, we prefer those conventionals. Emerging market bonds is slightly different. They can look attractive. I mean, I've got to be careful because you can buy local currency emerging market bonds. You can buy corporates. You can buy so-called hard sovereign bonds, which are sort of emerging market bonds but denominated in dollars. And the market is wide, and it very much depends where you are. So I would just leave it, if you're looking at that space, just mind your eye where you're investing there, because sometimes those spreads can be tighter than you think. But for us, just from a perspective of conventional versus inflation linked, we prefer conventional right now because we do think inflation has come down. I'll come on to the inflation point in due course.
Perfect. Just another quick question. A client has raised, obviously you're talking about at the moment you're buying very attractive bonds with very good yields, but he's making the comment that actually his own investments in Rathbones have been a bit lackluster over the last couple of years. Comment on that? Is it just a case you're well positioned moving forward, or?
Yeah, so as I say, from where we've come from, over the last couple of years have been extremely difficult. 2022 was a very, very difficult place to be. There were very few assets that gave you a positive return in 2022. Bonds were terrible. As I say, from the end of 2021 to where we are today, if you own that 10-year government bond that I was talking about in the UK, you've lost 25% in that asset. So that's supposed to be the sort of risk-free defensive bond lending to the UK government. But because how rates have gone and where inflation's gone, the value of that asset is now 25% lower. So that's been very painful. Now, as I say, for us, we had very little in bonds at the start of that period. So we've not taken the brunt of that pain. We have been building up those bonds as yields have been rising. And so the bonds that we've been buying over last year, we've probably lost a little bit of money on because yields have continued to go higher. But as I say, it's been incremental building that up. And I'd say where we are now, we think bonds look pretty good value. And that's probably, that's why we are at the highest level we've been. On the equity side, equities were pretty tough last year. Again, I can't think exactly what the S&P did last year, but it was pretty nasty loss. And as I say, there were very few, there weren't any mainstream equity markets that gave you a positive return. So, for us, it's almost been an element of just defending our capital, trying to make sure that we've not lost too much money last year anyway. And yeah, we lost a little bit of money, but it wasn't too bad. And then trying to capture as much of the upside this year. But again, equity markets, they're up a little bit, but not a huge amount. We had a bit of a bounce back, but markets have sort of sold off over the summer. So it's been a tricky period because, don't fight the Fed here. This is the point, is when the Fed are hiking rates like that, it is very difficult for investors generally. But as I say, where we are now, we think the Fed is likely pausing here. It may have one or two to go, but the vast majority of that hike is done. And as I will come on to inflation, I didn't want to skip. Oh, I'll tell you what, why don't I skip on? Here, this is the inflation slide. You know, if you look, this is something called true-flation. So there are question marks over the official measurements of inflation. I'm not going to go into the technicals of that, but I thought this was quite interesting because it actually, in particular, shows the UK is much higher than what the government reported rate is. But in the US, you can see there that US inflation has come down significantly over the last year, from near on 10%, true-flation anyway, to below 3. And the US reported rate at the moment is 3.2. So inflation has come down significantly. And that is because the vast majority of the reason why inflation went up so significantly was twofold. One was COVID, which I think I talked about this on the last webinar, but you know, the significant disruption to both demand, because the US government was sending out checks to every single household. They were stuck at home buying everything they could manage to order online from Amazon at a time when supply chains were significantly disrupted, and that pushed up the cost of everything. And just as we thought we might be getting on top of that inflationary issue, you then had Russia invade Ukraine, pushing energy prices through the roof, commodity prices through the roof, which has had sort of a ripple effect and kind of threw petrol on the inflation fire. And so ultimately, global economies have been working through that for the last few years, and we have worked through the vast majority of it. Now, that impact has been felt far and wide, because it wasn't just on goods, it was then on services, as you know, your local pub pushed up prices to, you know, account for the fact their food costs had gone up, their energy bills had come up. So you get that sort of lagged impact on services. And again, that's starting to come down now. And even labor, whereby you had a lot of people left the workforce because they retired early in COVID. We've had a significant impact on the workforce from long COVID and mental health issues. That is sort of an unknown, but it's estimated to have taken a large number, you know, millions of people in the US out of the workforce. And again, that has pushed up labor costs. And add to the fact, I think one of the sort of slightly missed issues has been that through COVID, if you were running a pub with 6 people, if you remember, you think back to 2021, you know, at any one point, probably 1 in 5 people had COVID. So if you're trying to run a pub with 10 and 2 people are off with COVID, you need to hire 20% more workforce just to make sure you've got enough people on the books to run the pub, knowing that at one point, you know, someone, you know, you're likely to have a couple of people out with COVID. And so I think companies overhired through that period as well. And I think they've been reticent to let those people go, having been slightly scarred. I mean, you know, I don't know about you, but there were many times when sort of pubs around me were simply closed because they couldn't find the staff. And I think companies been a bit wary of going back to that kind of period. And so they've kept their staff on the books. And so you've had an element of overhire, which I think has kept labour markets a little bit tight. Now, I'm just going to skip back to here. I sort of made the point, you know, we didn't want to get complacent, and, you know, with rates going up significantly, we do try and think about risks, what risks might be out there. And I think this is a really interesting area. Now, we're looking at sort of Airbnb, and I mentioned that, you know, if you are a homeowner in the US right now, you've still got your job because the job market's pretty strong. And actually, your mortgage hasn't really gone up because you fixed it for a long time. So there's no reason for you to move, but there's no reason for you to sell. So you don't have any forced sellers like you had in 2008. And that was a big issue in 2008. Rates went up. People couldn't afford their mortgages. In many cases, you know, they'd put no deposit down. If you remember, you used to have these ninja loans, so no income, no job, and you could get a mortgage anyway. And you know, I'm sure you've all seen the sort of Big Short and things like that. And and people were literally selling their houses, posting the keys back to the bank. We are not in that situation this time. You know, we've not built up a big credit bubble in housing. Banks are strong. You know, they are very well capitalized. The regulators have done a very good job ensuring that if we go through any kind of problem, we're not going to have a banking crisis like we had in 2008. But there are always things that we need to think about, and Airbnb is one of the things we've been thinking about quite a lot, and it's something that wasn't really around in the last time rates were this high, which was 2007, 2008. Airbnb I don't think was launched until 2012, and you've seen a massive increase in people owning properties which are being Airbnb'd, either second homes, or in some cases, businesses have sort of sprung up and, they bought houses and they rent them out for Airbnb. Now, you are seeing a bit of pressure on Airbnb. You might have seen in New York that they are clamping down on Airbnb and stopping people Airbnbing out their homes and saying, if you want to put your place on Airbnb, you have to be in the property and host it. So you cannot basically Airbnb the whole property, which, as you might imagine, puts a skewer through a lot of the Airbnb market. And you can see here how Airbnb revenues have been falling quite aggressively across the US. I think there's a couple of reasons. One is regulation. I think the other is the end of work from home. And I'm not saying it's ended. There's plenty of work from home happening, but companies are encouraging their employees back to the office. And I was in the US earlier this year. And it was very clear that whilst people weren't back in the office a lot, it was remarkable actually that so many businesses still had a lot of people working from home, but they were definitely encouraging them back. And the sort of idea of people being able to remote work for long periods of time, I think is coming to an end. And so I think people who thought, oh, I'll go down to Phoenix for a month and I'll just work from there, that is not happening anymore. So I think you're seeing some headwinds to Airbnb. And the problem is if you've started a business whereby you've bought 10 properties over the last 10 years, as you've built up a little Airbnb portfolio, you've probably taken out some debt to do that. And suddenly you're finding your income is down. Maybe some of the debt you've taken out is floating. So actually, suddenly you've got debt you need to service, and you've got a falling income to be able to do that. And so perhaps, you might see some forced selling in the property market from people who have built up Airbnb businesses and no longer can service their debt, and so they need to sell these down. And again, it's not something we think is going to be disastrous in any material way, but I think it's just something to highlight and just really worth thinking about how economies can change. And because of that, you have potentially a new risk in the market that you didn't necessarily have before. China.
Sorry, Will.
Yeah.
One just came in, just going back to your comment about if banks are so well capitalized, why did Silicon Valley Bank happen?
That's always a good question. I will try and keep this short because I could probably talk about it for a good long time. Silicon Valley Bank was a very special case, in particular that they had significant clients who were sort of venture capital businesses. And when money was very, very cheap, you saw a lot of money flowing into venture capital. So, these sort of private equity type businesses. And these venture capital businesses, these startup businesses, typically banked with Silicon Valley. So all this money that was flowing into these startup businesses, they were clients of Silicon Valley Bank, and they parked all their cash with Silicon Valley Bank. And so the deposits at Silicon Valley Bank built up significantly over that period. And Silicon Valley looked at those deposits and they said, what can we do with these deposits? We can put them in government bond yields and get 1.5% to 2%. And we don't pay anything on our deposit base, so we make a nice little margin on those bonds. In theory, that wouldn't have been a problem until rates started to rise, and then people didn't want to fund these startup businesses anymore because many of them, quite frankly, were not very good businesses. They were very early in the startup phase. They weren't generating any revenue, so they were burning through that cash. So all that money that they had with Silicon Valley Bank, they were spending. And normally what would happen is they get a nice load of more cash coming in from venture capital to support the growth of their business. But when rates started going up, a lot of people said, actually, we're not going to fund these businesses anymore. So they burnt through that cash, and it was almost like a bank run. All of that money coming out, being spent by those clients, but not being replaced. So it was like a big bank run. And with all that money going out, they then had to fund that. The way they needed to fund that was to sell those government bonds that they bought. Now, of course, those government bonds that they bought with a 1% yield were now worth significantly less because, as I said before, bonds were going down in value as interest rates were going up. So when they sold those bonds, they crystallized big losses, which was very nasty on their balance sheet, and their balance sheet deteriorated significantly. They tried to raise equity in the markets. Everybody panicked, and everybody who had their money left with Silicon Valley Bank took it out because they were worried they were going to go under. So that hopefully is relatively clear, but that was kind of a microcosm of what happened there specifically. Now, there are banks who have bought those government bonds, and so they are sitting on losses, but as long as they don't see people pulling out their money, which they shouldn't do because there is no reason to have that, those bonds eventually will just pay back at par. So it is only an issue if you see people taking out lots of money from a bank. And as I say, unfortunately for Silicon Bank, they had that because of their client base. Is that okay?
No, perfect. Thank you. Let's crack on to China.
Yeah, well, it's always worth talking about China. You know, second largest growing economy. China was an area that we had a reasonable amount of money in. Probably, well, I joined the funds in 2015, and we, always had a reasonable amount allocated to China, either directly or at the time we actually owned a China fund. We have very little direct exposure to China, and increasingly less exposure just through the companies that we own. Our concern with China, they went through a long period of trying to have a zero COVID economy, which was obviously terrible for growth. And then they pivoted and went to open it all up, and everyone expected them to return to normal growth, and that hasn't happened. And I'm not going to sit here and explain why that hasn't happened. I think it's very difficult to understand. But it has been a lot slower to recover than people thought. Now, they have other problems, including a big property issue, whereby they have overbuilt significantly. A lot of their big property companies have taken on a lot of debt. That in many cases they ran out of money. They couldn't finish building the properties that they promised to build. They couldn't make good on that. People have been losing deposits in some cases. Companies have been defaulting on some of their bonds. So it's not a particularly healthy economy. It is over leveraged. Growth is now slowing. They have a different regime now under President Xi, whereby you've seen a number of crackdowns on different parts of industry, starting with gaming in, I think, 2018. You had a crackdown on education in 2021, I think it was. Now, when I talk about these crackdowns, just to be clear, many parents would be absolutely delighted because the crackdown on gaming was about trying to stop children under 16, I think it was, from gaming 24/7. So they sort of limited the amount of time that children could game, which obviously weighed on the sector. As I say, I'm sure a lot of parents would be delighted to blame the government as to why they're not allowing their children to play video games all the time. And the education side was a little bit more complicated, but I won't go into it. But they cracked down on the private education sector, particularly around tutoring, and almost overnight wiped out some very big Chinese businesses which have grown up around private tutoring. Just highlighting the fact you're seeing more and more intervention from China in their economy. a little bit of a reversal from their move towards being a more capitalistic society. You've seen crackdowns around areas of big tech as well. And more recently, they're doing a purge in the healthcare sector around corruption. Now, that obviously you might think sounds good, but typically often these corruption purges can be a little political, shall we say. So it's just an area whereby we're finding that doing business is becoming increasingly hard. It's increasingly at risk of intervention. And so for us, I think, it is an area where we are happy to have less exposure. And we reduced our exposure down in early 2022, and we've not built that back up at all. And we only really have a couple of direct investments there. They're two Hong Kong listed businesses, one called AIA, one called Tencent, both of which we still think are really good long-term investments. And we're willing to own those businesses and take an element of risk, but we're happy to limit that exposure for the moment. The other issue clearly as well is that their exports are going down as a lot of countries or a lot of businesses elsewhere are deciding to remove their reliance on Chinese exports, particularly for more strategic areas of business. And you can see that a lot in what is happening at the US at the moment, where you are seeing significant investment in the US supported by so-called Bidenomics. So this is a lot of various legal acts brought in by the US government to either spend money through things like the Infrastructure Act or to encourage companies to invest on UK shores through things like the CHIPS Act and the Inflation Reduction Act. The Inflation Reduction Act is a ludicrously named thing. It's nothing really to do with inflation at all, as far as I can tell. But nonetheless, this is encouraging significant investment on US soil, and you are seeing, ground being broken on huge numbers of construction projects, either in the infrastructure space or things like building chip plants, so where they build semiconductors, where you've got a massive plant in Arizona, for example, huge amount of renewable energy investment, which is a part of a lot of what we're seeing in the Inflation Reduction Act. So you can just look at these numbers and see how large they are. And this has been a big support for the US economy over the last 6 months. Again, as I mentioned, I was in the US earlier this year. I went through sort of industrial America, so Atlanta, Chicago, Milwaukee, seeing a lot of industrial businesses. And, they were saying that this is starting to feed through and have a real impact on their earnings. And so I think this is a big deal, and it's an area where, we got various investments we think can benefit from this. And, it's a reason why we think the US economy can continue to be resilient, even in the face of higher rates. Some of that, of course, is supported by this so-called onshoring, which I sort of alluded to earlier, but that is businesses who have decided they don't want to be reliant on Chinese exports. They want to bring their supply chains either closer to home or at least have more than one supply chain coming out of China, so-called dual sourcing. And what I think is fantastic and really ironic about Bidenomics is, for me, this is basically make America great again. These are Trump's policies to a certain extent, right? Investing in, the US, bringing back jobs, not relying on China so much for strategic assets. So a lot of this looks very Trump-like, and I think that's important from the perspective of, if we have a change of government in the US, next year, or at least, the election is the back end of next year, so it'll be 2025. I don't think you're likely to see an en masse reversal of many of these policies. There may be an element of a reversal on areas like renewable energy, because I'm sure if it is Trump, that he will, reopen all sorts of fracking, and the energy companies will be absolutely delighted. So it might not be quite as supportive for renewable energy. However, I think the US also recognizes the importance of, decreasing its reliance on oil anyway, and having a more diversified energy base. So I think all of these tailwinds are here to stay. And things like the Infrastructure Investment Act, it is not just 1.2 trillion this year. This is spread out over the next 10 years. So it is a nice tailwind for the US economy over the next decade.
Before you move on, can we just a couple of questions come through? Would you agree US growth is debt fueled? Debt GDP is now 120%, and therefore there is a huge risk in the US growth story?
So I think there's an element of debt to this. Clearly, they raise the debt limit every few months, it seems, at the minute, and we have to sort of rigmarole around that. Yes, there is an element of debt. If you think about where the debt has moved, it has moved off private balance sheets onto government balance sheets. There is no doubt about that. Now, we've had an element of inflation, which of course helps bring down some of that debt pile. And to a certain extent, I think the US does need to be wary of overspend. And, some of the fiscal policies I think they put in place around supporting the consumer, I think was probably overkill, and sending checks out through COVID, many of which is now at an end. They've gone back on student loans, which I think is probably the right thing to do. At one point, they were talking about cancelling a huge amount of those, which of course would have added another significant chunk to the debt. And from this perspective, I would be much more comfortable from this perspective if you had a Republican government in, because they are likely to keep more of a lid on the debt profile of the US than perhaps we've seen under Bidenomics. But I would also add that a lot of the incentives around these acts, so this is not, Inflation Reduction Act, the government's borrowing 700 million to inject it into the economy. It is that they are putting forward 700 billion worth of tax subsidies to do this. So it's a slightly different way of spending. And if you think about this, though, it's investing in the economy that should have trickle-down effects, that should have ripple-out effects into the wider economy, creating more jobs, driving growth. And you are seeing that. I think the US GDP printed a 5% figure recently. But yes, you're absolutely right. It's something to be aware of. Now, 120% debt to GDP is high, but plenty of economies have run quite comfortably with a high level of debt. That high level of debt is actually a reason why I think inflation is likely to remain tamed, because when you have huge amounts of debt in the system, it's just not feasible for rates to remain high for long. Eventually feeds through, eventually reins in government spending.
So thanks, Will. And a question came through just previously about China. Your long-term growth outlook on China once the economic supply chain rebalancing has taken place? Will there be a return to high or even medium growth rates?
It's always a big question what Chinese growth rates are. Having said that, I think it's just as good a question what Western growth rates are, actually, because I think a lot of this data is, I think UK GDP was so supposedly revised up, wasn't it, to say that actually we'd grown the last couple of years. So I think all of these figures you need to take with a pinch of salt. Longer term for China, that they have a burgeoning middle class, which I think is likely to continue to grow. And that's why areas like Tencent, like AIA, which sell life insurance into the Chinese economy, have plenty of room for growth, particularly with AIA, where they're underpenetrated. Do I think China's going to get back to north of 5% growth on a medium-term trajectory? No, I don't. I think they are carrying too much debt. They are facing significant headwinds, on their export manufacturing markets. So I think they will continue, and they obviously have a population issue as well. So a bit like Japan, that is likely to weigh on growth. So I suspect they will probably have off the top of my head, but I suspect a 10-year average growth rate of around 2 to 3% real, trending down over time. What their printed figures might be, we will see, and obviously it's going to slightly depend on whether President Xi remains in power for the next decade. He's certainly ensconced himself in power. So yeah, I suspect it's trending lower over the next decade.
Perfect. Thank you. Carry on.
Thanks. I already covered a couple of these slides. This was a little bit what I was alluding to on UK mortgages. So just so you can actually see it here, you can see this is compared to 2016. And you can see that floating rate has gone down. As I say, it was actually much higher 5 years before that. And you can see how that 5-year rate has picked up materially. So whilst 20% of the population were fixed in 2016 for 5 years, that's now over half. So I think it just makes the point that you've got a significant delay in the push through to the UK economy. I mean, I think the UK economy is an area that is likely to be under a bit more pressure. You've seen a number of businesses starting to go under. Now, I think you've got to be a little bit careful with this, because your Wilcos and your Pizza Huts of this world are by far, certainly not the high quality businesses that we look to invest in. And they're just the kind of businesses, quite frankly, that should be going under. And I say that because we've been in a period where low rates are not good for productivity. You need an element of creative destruction. And these zombie companies, which have been allowed to continue because they've had access to very cheap financing, are not great for long-term economic growth. And actually, you arguably want to see bad businesses go under and for that capital to reallocate itself to more productive businesses. I think the UK is in danger of drifting into recession with rates where they are, particularly because that pass-through is quicker versus the US to impact households. And, if you are going from a 1.5% to 2% mortgage to a 5% to 6% mortgage, that is a material impact to your monthly finances. And so, I expect that to weigh on growth over time. Having said that, there are businesses taking advantage of this. And this is one of the really important points around if you go into a downturn. And that is particularly when rates are high, businesses that are over leveraged, they're carrying too much debt. They've got to worry about servicing that debt. Are they getting enough cash coming in to service that debt? If they've got bonds up for renewal, are they going to be able to refinance that in the markets at a sensible level? If they're in retail, their consumers under pressure. So they've got a lot of problems. And it probably means that they're not investing in the future. They shut down, CapEx, so capital expenditure, which is normally what you do every year to invest in the long-term prospects of the business. But when you're fighting fires around debt, these are things that you don't do. And they're very bad for a business longer term. Whereas businesses that have strong balance sheets, that are well managed, that are able to continue to invest in the future, they are able to take advantage of this kind of weakness for their competitors, whether that's because their competitor goes under and they can pick up market share, like we've seen with Next. Next is a business we own. We're not particularly confident on the UK economy, but you've seen in Next results, even as the UK consumers been under pressure, Next have continued to deliver. And they're picking up share from their competitors that have gone under. They are picking up interesting brands on the cheap as those brands go under, and they can pick them up and manage them much better. And so I think it's a really important point to note that when you own high quality businesses and you go through any kind of downturn, those businesses come out stronger. They come out with more market share. They come out in a much stronger competitive position than they were going into a downturn. And so at the time, if we did go into a bit of a downturn, it can be tricky. But as I say, for us, making sure we are focused on high quality businesses, and I think we've shown this before, but it is a trend through our portfolios. When you look at the types of businesses that we own, they are high margin. They have very strong management who understand the right places to allocate capital at the right time. We like to have businesses where their products and services are resilient no matter what is happening in the economy, many times because they have nice structural tailwinds behind them. And so, again, even if economies go into a period where growth is not particularly strong, the drivers behind their businesses can continue to do well, and they can continue to perform. I'm wary of time. Ian,
I
how
was going to
much
say, Will, I
doing?
was very conscious that we'd booked you out for an hour. I don't know if there's any last sort of important points or topics you just want to very quickly cover off.
So, as I say, I think as sort of summary, for us, the market has moved to a position where there are lots of interesting opportunities that they weren't before. I'd say for us, in many cases, it's locking in those longer term rates in bonds. It's the ability to buy those government bonds with attractive yields, which will help protect the portfolio if we go into any kind of downturn. Within the equity space, we continue to focus on high quality businesses, as we always do. We think those are the ones that are best set for long-term returns. They're best set to be able to weather any kind of downturn. If we go through very aggressive growth in economies, sometimes they can lag a little. But for what we're trying to achieve, which is compounding growth year after year, those are the types of businesses that we absolutely want to own, and those with really nice structural tailwinds behind us. And then within our sort of diversifier section, again, because rates are moving up, there's some really interesting opportunities within that space to buy things that are giving us genuinely uncorrelated returns and are able to help protect the portfolio if we see slightly slower growth.
Perfect. Look, Will, thank you very much for taking time out of your busy day to join us, and thank you
No
very much for
problem.
the webinar. Really interesting, really informative. Ladies and gentlemen, thank you very much for taking the time out of your day to join us. If you feel there are any questions or topics, issues that you'd like to discuss, please get in touch with your advisor at Abbey Wealth. So thank you very much for everyone who attended. Thank you.
Thanks, Ian.